Hello again. My name's Miles Pitcher. I'm the owner of Superior Lending. We are seeing a change in the market where we have seller paid closing costs back, and they are available to our purchasers, our clients who are buying new homes. Quick reminder to make sure you subscribe to the channel. Thank you for that. So with seller paid closing costs, there are several strategies that we are looking at, evaluating, and using right now. Number one would be a permanent rate buy down, and we've done a video on this already. I'll post the link. A temporary buy down, we'll look at that here in the upcoming videos. Then there is an option of buying out your PMI or private mortgage insurance. And of course, you can always use the seller pay closing costs just to cover your normal regular closing costs. But we're finding that there's a good chance you can get a generous seller paid closing cost chunk, which could be used for any one of these here. We are looking at conventional loans on these, though you could do a permanent and temporary buy down on things other than conventional loans. But on the PMI buyout, we're looking at conventional. I want to remind you that if you are using your own funds, borrower paid is what that means, rather than funds from a seller or a builder, you would want to definitely calculate your break even. And I have a video that shows you how to calculate that to make sure it's worth it, what you're doing with the buy down. And these options are available on a borrower paid situation, but today we're focusing on the seller is paying for your buy down, and we'll take a look at that. So just a couple of things to keep in mind with private mortgage insurance. These are provided by multiple companies out there. There's lots of companies that do it. They base their rates or how much you pay on your credit score and the down payment. Another factor is how many borrowers you have and also zip code that you live in, zip code and state. And so today we're going to look at, rather than paying monthly mortgage insurance, we're going to look at doing what's called a single premium. It's a one-time upfront fee that buys out and removes the mortgage insurance. And just like I mentioned before, it is affected by your credit score and your loan to value. So we'll go through two scenarios today, and let me show you what we have here. So first, we have a client that we're assuming a 740 FICO, one borrower. We have the seller giving us $7,790 in seller credits. This can be used for, we can go back to them and ask for a price reduction, or we can use it as seller paid closing costs. This is a 5% down conventional loan we are doing. So in the first column, and you'll see the orange arrow there, this is a demonstration of 5% down monthly mortgage insurance. We've taken that credit that the seller is willing to give and asked for a reduction in purchase price. So you can see rather than $500 purchase price, it's $492. 5% down gets us to a loan amount of $467. There's the current rate, APR, and by the way, the rate is as of July 6th, 2022. APR shows right there. 360 months is a 30-year loan. Here's your total monthly payment, including property taxes, homeowners insurance, mortgage insurance, principal, and interest. And you can see that right there. The monthly MI is at $113 a month. Now let's hop over and compare against our mortgage insurance buyout, our single premium. And again, we've mentioned the cost of doing that based on the credit score, and 5% down is $7,790. So we start at $500,000. Our loan amount's at $475. Everything is the same except we drop the mortgage insurance, and you can see our monthly payment and the improvement there, $2,807 a month. Okay. Third option I thought I would throw in just for fun is, let's not buy out the PMI, but let's buy down the interest rate with a permanent buy down. So rather than using that $77.90 to buy out the MI, we're using it to buy down the rate. With that amount, we could go from 4.99 down to 4.625. You'll see that with the green arrow there. APR is lower. We still have our monthly MI, 114, but with the lower interest rate, we're at 28.16 a month. Let's take a look and see what this does, or what the effect is over 5 years, 60 months. So again, our three scenarios in the same order, but what we've done is taken the total interest paid plus the total mortgage insurance paid. And you can see that the option of buying out the MI or buying down the rate are very close to each other. 5 years, you'd be paying $114,000 in interest and MI, actually no MI, just straight interest. And then because of the lower interest rate, you can see that buying down the rate is a great way to go on that third option. They're close to each other. Let's take a look and see what happens if our client has a higher credit score and we have another borrower added in. So here's the scenario. Same scenario, except we're dealing with better mortgage insurance rates because of the credit score, and there's two borrowers. You'll notice that we have a smaller seller credit because that's all that's needed to buy out the mortgage insurance on the single premium, $45.12. So we take that $45.12 option one as a price reduction, and you can see what that does. You'll notice the MI here, 74, is quite a bit less than our last scenario. What if we were to buy out the PMI, use that $45.12? You can see what it does to our monthly payment is the same as the scenario before, same interest rate. Option three, we still pay the monthly MI, but we're going to buy down the rate. And since we're only working with $45.12, that means we are not able to buy the rate down as far as we were on the other scenario. We're only able to get down to 4.75. So you can see what that does to the monthly payment. Let's look at what that does over 5 years. Again, you can see that the second and third option are still really good compared to the first option, but the gap has narrowed a little bit. In short, there are plenty of options here to do. I will mention I like the permanent buy down and the buyout of the mortgage insurance if we're in a situation where a client has tight debt ratios already. If they don't have tight debt ratios, the temporary buy down is something that we should look at, and we'll do that on the next video. But by doing a permanent buy down or the permanent buy down or buying out the mortgage insurance, this helps the debt ratios of the client. It helps them to be able to qualify for more in what they're trying to buy. All right, rate update. So boy, we had a really nice couple of weeks of rates improving. You can see the trend of that line was going upward, which means rates were getting better. This is an inverse chart. And then today we really just kind of hit a wall of resistance there and got a little bit worse in our rates. Still a real nice improvement. We don't know if this is, well, I personally doubt it's a long-term improvement here. I think we still have room to get worse in our rates, but we're watching to see what the Federal Reserve is going to do on their raise of the Fed funds rate in July. Some of the big news out there is that quarter one of this year, the GDP was negative 1.6%. The expected for quarter two is negative 2.1%. So the rule of thumb on Wall Street is 2 quarters of negative GDP indicates a recession. So again, we have more evidence of a recession coming or that we are already in it. The quarter two numbers aren't going to be recorded until 3 months after the quarter ends, which means in September, we will get the official number. And there's actually a government agency that officially declares that we have been in or are in a recession. So we'll watch for that. But it's been several months, we presented to you some historical predictors of recessions, one of which is an inverted yield curve. We are back in an inverted yield curve again, where the 10-year and the 2-year are inverted and have gone negative. We're there again. We've been negative a couple of times. So definitely another sign showing that or saying that recession is going to happen. Just remember, inflation is the enemy of the mortgage rates. As we get inflation under control, we expect mortgage rates to improve. I hope this is helpful for you to see the opportunities that there are right now in having sellers help buyers with more purchasing power or to get a lower monthly payment with where rates are by using seller paid closing costs. Please let me know if you have any questions. My name's Miles Pitcher. I'm the owner of Superior Lending. We'll be back next week with another tip.